Investors Chronicle.
Companies and Market Show. It is Wednesday the 26th of October as we record, a little earlier than usual. On the show today we have Julian Hofmann, Mark Robinson and Alex Hamer. And as always, our host Dan Jones. Dan, what's coming up on the show today?
Hi, John. Yeah, this week we have the first half of our AIM 100 feature in the magazine. So we are going to spend a bit of time talking about 3 companies from the first half of that top 100. Then we are going to be speaking to our commodities expert, Alex Hamer, about the US Inflation Reduction Act and how that's starting to feed through to some companies in the US, but also over here. And finally, we may take a little look at some interesting goings on in the world of advertising, but that is time permitting, so we'll see about that.
And as usual, before we get there, a quick news roundup with me. The number of profit warnings issued by UK-listed companies in the third quarter hit their highest level since 2008, as companies faced higher costs and slumping demand. Some 86 profit warnings were issued during the 3-month period. Lots of earnings reports at the moment. Let's go through some of them. Google's parent company Alphabet fell short of analyst expectations for digital advertisement growth. The 6% rise in the third quarter for US advertising revenue missed the 9% target and triggered a tech sell-off as fears of an economic slowdown in the US grow. Deutsche Bank has reported one of its strongest quarterly performances since before the financial crisis and is on course for its best annual profits since 2009. Meanwhile, Barclays, Santander, UniCredit, Standard Chartered, HSBC and UBS have all beaten analyst estimates. Huge profits for these banks have come on the back of rising interest rates in the third quarter. Education specialist Pearson is on track to meet full-year profit expectation after a very strong performance from its English language arm. Some good news at retail company THG, whose shares jumped 16% after it stuck with its full-year trading guidance in a third quarter update. The company said it still expects to post annual revenue growth of between 10 and 15% and adjusted cash profits of between 100 and 130 million pounds. Specialist travel retailer On the Beach said in a full-year trading update that annual sales outstripped pre-pandemic 2019 levels by 16%, but did warn that the cost of living crisis is impacting demand for holiday bookings. Shares fell 3%. And Made.com is in death spiral territory. On Wednesday morning, it confirmed that sales had stopped and its market capitalisation has been further demolished. It is now down from 200p a share at listing in June 2021 to now trading under 1 pence. As I said, loads of earnings reports this week. You'll find them in the magazine and on the website. But for now, back to the AIM 100 with Dan and co.
Thanks, John. Yes, as you say, this week our cover feature due out today by the time you hear this is the first half of our annual AIM 100 Roundup. I say Roundup, but really it's a detailed look at the 100 largest companies by market capitalization on AIM, albeit that largest 100 was decided a month ago, so a few changes, especially in a year like this when share prices are moving around quite a bit. What we've done today is we've taken 3 companies from the first 50. The second 50 are out next week, I should say. We've taken 3 companies and we're going to discuss them in a bit more detail, starting with the choice of our company's editor, Mark Robinson. Mark, you have singled out Pan-African Resources as not necessarily, a stock to buy right now, but it's certainly an interesting proposition, shall we say, at the moment.
Yeah, I think it's also some musing on the gold price as well, because we've had a year where we've seen, or 18 months where we've seen a massive increase in the money supply and the US and elsewhere as well. But this sort of dollar debasement, or the subsequent dollar debasement, has done little in terms of propping up the gold price, because there seems to be a few other safe havens around at the moment. And given that the dollar, has got an inverse correlation to gold prices, this is what's held it down over recent times. But I guess with Pan-African, and Alex Hamer might want to comment on this as well, is that the most pleasing detail is that they've managed to keep a lid on costs, or largely anyway. And you've got to bear in mind that it's it's an energy intensive business as well. Some of their costs at least are sort of dollar denominated, so that presents a real problem for them, or a potential problem for them. But they've kept a lid on costs. As I say, it's only up by about 2% on the prior year, and they substantially reduced their debt burden as well throughout the year. And that point on costs as well, it sort of contrasts with some of the bigger players in the market, such as Newmont and Barrick. So yeah, I mean, it's cheap at the moment, as you might expect. I think it's just on a forward rating of 4 times adjusted earnings. The point to consider as well for investors is that sometimes, well, very often actually, if you're going to gain exposure to the gold price, the way to do it really is often to go through the gold producers themselves because of their operational gearing. Whether we've seen a sort of floor for the gold price at the moment is difficult to say. Perhaps we could bring in Alex here if he's got any thoughts on where the price might be headed.
Yeah, I mean, as all forecasters would have found in the past year or so, it's a bit of a mug's game. For gold, we've got this real relationship with the US dollar, but also interest rates in the US, and it all points to confusion in the year ahead. So the gold price has been fairly weak in recent months. We've seen levels about 1650, but I think what will make a difference is when the US Fed is kind of seen to have got a handle on inflation, and it's not clear when that would be. So, I don't have a massively clear forecast. I mean, it's not just me saying things are muddled. It's analysts who are kind of shrugging at the moment. Obviously, the gold bugs are doing their usual. Monetary supply is insane. GDP debt ratios have gone mad, and gold's going to be $5,000 an ounce. Just so and people will be selling silver to eat. That's the kind of spread of forecast. But any gold producer that can keep its costs down now is in a pretty good spot, I think.
Yeah, I think Pan African is pretty well set, especially compared to some competitors there. And I just would reiterate that point as well, is that investors can get a march on the market if they invest in companies rather than the physical metal itself, because you do get that benefit coming through of operational gearing. So that's where we are with gold, Dan.
As you say, it seems to have sorted its operations, its balance sheet out a little bit. There is perhaps a contrast there with 1 or 2 other gold miners, which are mentioned in the AIM 100. But I think the other interesting thing, as you say, Mark, is just the level of that valuation right now. It's pretty bombed out. I was speaking actually the other day. We had an event last week in Edinburgh, and there was a deep value investor was there, former Baillie Gifford man. So I think I can see why he left Baillie Gifford, given their philosophy nowadays is very different from deep value. Yeah. But he seems to like, he said he just likes buying things on, PEs of 2 and waiting for them to reverse, and, 1 in 10 will come good. This is not quite down those levels, but as with many stocks on AIM this year, it has fallen. This is a bit different. Let me qualify that, because overall this year, the share price is relatively flat, but that does disguise a bit of a run up as people thought high inflation equals good times for gold, perhaps, and then came back down when they realized otherwise. But it does just show, some of these companies are trading at very, very cheap levels.
Yeah, I mean, I don't know if that's enough in itself to prompt investors to take action, but you've just got to sort of snout out the quality there and the value in the market. It is true as well that we are reaching the point now where people should really start be looking around. Actually, I've been keeping an eye on volumes in AIM as well, and they've trailed off quite appreciably since March of this year as well, which indicates that people have taken a step back and are just reassessing where the market is at the moment. Of course, it's sort of as with the small cap market as well, it tends to be a good deal more volatile than the benchmark when markets are under pressure, or in fact when the economy itself is under pressure. So it's something we'll be looking at in the magazine over the coming weeks and months, I think. Yeah.
Let's move on to the next company on the list. It's one I've singled out, James Latham, which I think, again, is a good example of a quality company you can get on AIM. The index had a very tough year. A lot of investors have been burned. A lot of growth-focused stocks in particular have obviously struggled in particular. But James Latham, again, it's not had a fantastic year. It's not been as bad as some, but to me, this seems like a quality company with end markets, which are a bit uncertain, but it's been operating in them for a long time. It's the timber and panel manufacturer, for those who don't know. Another company priced it very, very cheaply just on basic PE ratios, although as Mark says, that's not the be-all end-all. There are questions this year with a lot of manufacturers. I think it's been dealing with huge increases in input costs. I think, as we say in the piece, these were already up by a third before the impact of the war in Ukraine, which produced some challenges in terms of obtaining alternative supplies to replace products that previously sourced from Russia. So there are definite challenges there, but again, as you say, Mark, if this is the kind of time when people should perhaps be starting to consider what might they be looking at.
Yeah, I think it differs from Pan-African because there is an underlying, well, its share price is not linked to the value of an underlying asset, anything like that. So you've just got to take a call on the market. Obviously, it's understandable why the share price might be depressed at the moment because the sort of trading backdrop is has deteriorated and is likely to continue deteriorating through into 2023 for some time. But it's a proven company in the past, and so it's a pretty good example. In fact, a better example, really, of those type of value plays that our readers will be looking at, or our listeners, rather.
For me as well, it perhaps contradicts, the notion that AIM is just all about, fast growth companies that go up quickly and come down quickly because, as I say, it's been around a long time. It's been around, 250 years, a bit longer. Has that quality assurance, I think, has that, the assurance of quality, I should say, even in bad times.
As you alluded to as well, I mean, it's another story linked to US dollar strength because obviously, just operating that business has become that much more expensive through this year. But hopefully, as sterling reappreciates, and I mean that's no guarantee, but if it does, then the outlook for the company itself should improve on that basis alone. Even though aggregate demand into the markets that it sells into is likely to be flat at best.
Yeah, that is a good point. It has been hit by sterling weakness in the past, and clearly some of that will not yet be factored into results. I believe it's cost and revenue base is a little bit more balanced than it used to be, but we'll see how that comes through the next update. Now we turn to our third company. Julian has chosen, it's more like a couple of companies really. We're looking at the asset and wealth managers, of which there are several on AIM and several in the AIM 100. The specific ones we're going to talk about today, Brooks McDonald and Gresham House. Julian.
Yes, so these are a couple of interesting ones in the context of the AIMS market. Brooks particularly has grown quite substantially over the last 15 years. So they went from 500 million under funds under management to more than 16 billion at the last count. So it's been a very fast growing manager. The secret to its success, I think, is that it's based in sort of pleasant county towns. So imagine the sort of place where you might go and watch county cricket on a Sunday afternoon. And its customer base is kind of based around that demographic. So it's got a very sticky kind of, loyal base. So they have, retention rates well over 90% of their customers. And what they tend to find is even if they withdraw funds from certain parts of the business, like they tend to put it in others or it stays within Brooks. So it's they've kind of cornered that genteel market. Let's put it like that. And the secret to their success this year, I think, is the fact that they're doing quite well at upgrading their IT because they have such a stable base of clientele. That the challenge for them is not recurring revenue or recurring fees in that sense. It's trying to get the cost of servicing the customers lower, which is where their margin starts to come in. So they completed an IT project recently that's substantially brought down their operating costs, and that's kind of reflected in the latest upgrades for them, is showing that they're going to put EPS up by about 12% on the basis of this. So it's quite a substantial improvement if you consider that your your basic cost base is your basic income base is more or less steady and stable and fixed.
Yeah.
So it's an interesting business, and they've been far more. Their share price has been far more less volatile than almost any other. So they're down like all the other managers, say about 27% for the year, but that's roughly half the fall of most of its peers or any of the larger asset managers this year. So it's definitely a business to look out for. If they're getting that kind of operational performance in this kind of market. So Brooks are quite interesting.
Just on Brooks, as you say, they are an interesting business. They had a good run up as well since 2020. Before that, they were working through some operational issues. But it really does seem, in the past couple of years, they have, really started to. The share price obviously did very well in 2021, but also operationally, they've really come through. As you say, they're still seeing decent inflows this year from private clients, which is no small thing in the current market, and something that a lot of people will be envious of, I think
so. And there is room to grow as well, because that end of the asset management market is very fragmented. There are a lot of specialist businesses who service quite high net worth individuals, but with specific things like they do pension planning or money management or whatever. And if you can consolidate that into one branded business, the potential for fees, which is what this is all about, is considerably higher. So that's I think that's Brooks is on a good trajectory, despite the fact that the shares are down 20%, 27%, and you can pick them up roughly on a forward PE of 12, which is probably the lowest in 18 months, I would have said. I think quite promising from that point of view.
They do remind me of another business I'm doing similar things, which is Latham Asset Management, which is less private client, but more the kind of business where their business model is based on financial advisors outsourcing the investment responsibilities to them, and they've gone great guns in recent years. I do quite like this business from my perspective of some of my previous hats here at the FT. Some of the sectors we've covered in terms of they are really doing well cornering that market. So it does show that on AIM there are these interesting wealth and asset managers available. Latham is a bit more expensive, but another company we are going to talk about, Gresham House, Julian.
Yeah, so Gresham is a slightly more esoteric one than Brooks or Latham. It's an asset manager that deals in alternative assets. So then, for example, they own quite large chunks of Ireland, which obviously last time, but that didn't go very. There's a bit of a problem with absentee landlords in Ireland in the past, but so they have this variegated business model where they buy up forests in New Zealand. That's another thing. They've got quite a lot of alternative energy assets as well in various funds. It's an interesting. From intellectually, it's an interesting business. The question mark for me as an investor is whether the assets are kind of dangerously illiquid. So you could end up in a situation where theoretically, we're not suggesting that that's a problem at Gresham, but theoretically, if there's a call on funds, if there's a sudden mark-to-market crisis of some sort, then those classic illiquid funds are the ones that are the first ones to suffer in any scenario, in those kind of scenarios. So you kind of have to balance off the risk there. I think that would be my impression, but it doesn't make them any less interesting if you're looking for an asset that isn't all about just managing funds in Chipping Norton or something like that. But
a lot of their structures are investment trust based as well, which should help with the illiquidity point, up to a point at least, in terms of there being pressure on them to sell those assets. It is quite interesting that the niches they're in, as you say, forestry being, I think, the biggest single subsector which they're involved in. New energy, sustainable infrastructure, as you mentioned, that obviously has been popular again this year, which can be easy to forget sometimes. There's been a bit of a political backlash against sustainable investing this year, and certainly investors as well, I think, have realized that some of these strategies aren't just going to go straight up forever. But the inflows are still coming in. There's a lot of interest, obviously, in renewable energy right now.
Of all of them, noticeably, their inflows have been quite healthy, I think. And you do wonder whether that is related to the fact that they're owning physical assets. So there must be a correlation between the fact that they're not really open to the public markets in terms of what they invest in. So that is perhaps the upside of having an alternative asset, is that you don't have to, your daily net asset value is not determined necessarily by what the current market prices of what might be a publicly held asset, whereas a forest somewhere is harder to value and on a day-to-day basis. You could turn it all into furniture, I suppose, and sell it. But it's an interesting investment play. But I think you have to be more savvy about it than the case is slightly more nuanced than it is with Brooks, which is a much more straightforward investable asset from a private investor's point of view. So you'd have to do more work on whether that is a class of an asset class that you would want to get involved in, I think.
Yeah,
but it's no less interesting for all that.
Indeed. I should say as well, this is Simon Thompson has written about Gresham a fair amount, and he does like them currently. As you say, everyone should do their own work on the company, but we have written a decent amount about them through Simon's columns, so do look out for those if you are interested.
Yeah, never argue with Simon Thompson on anything. I think that's also the lesson to draw from that.
Not necessarily investment advice, but yeah, you wouldn't have gone far wrong to have done that in recent years. That is the end of our AIM section for now. As I say, the first 50 of the top 100 are in the magazine this week. The second 50 will follow next week, and we'll talk a bit more about them on next week's podcast as well. But for now, we're going to turn to a different market entirely. We're going to turn to government spending in the US, specifically the passing of the Inflation Reduction Act a couple of months ago has started to feed through to some companies. This act, despite its name, is putting quite a lot of money behind new technologies, trying to really shift the dial in terms of energy production and renewable energy and things like that. And that means a lot of lithium companies in the US, but also some in the UK, are starting to see the benefits. Alex Hamer, you have written about this for us this week. Can you say a bit more?
Yeah, I mean, this is almost a sequel story, the one in this week's magazine, because a week or 2 weeks ago, I wrote about how Europe was getting left behind in terms of not just mining lithium, but also processing it into a form that can be used in battery factories, which are often called gigafactories. And then that gets put into electric cars. So there's like most things, there's a multi-stage supply chain here. And you kind of need all of the parts to make it, well, most of the parts even to make it work. So I wrote that story saying Europe's fallen behind after a mining CEO told me he would love to ship his lithium product to Europe, but instead it'll be shipped to China and then potentially to Europe down along the way. So I thought I made some comments, or people made some comments in that story about how the US was doing things differently with a lot more government support. And so I thought I'd expand on that. And that has come off the back of the US government through the Department of Energy, and it's also a White House policy as well. They've announced $2.8 billion worth of direct grants that have gone directly to companies trying to build processing facilities that go into the EV space eventually. And this is pretty big. There's an Australian company that has a mine in Africa, and they are mining graphite, so not lithium itself, but part of that battery environment, I guess. And they've been trying to get this Louisiana plant off the ground. The company's called Syrah Resources for a few years now, and the market's come up recently, so their fortunes have improved, but they've just been handed $150 million, which is a significant amount if you're trying to build a processing facility. And I think the size of these projects ranges from maybe the total cost would be $2 billion, the total cost might be $200 million, and the government's just paid for most of it. But it shows a real commitment to getting this domestic supply chain off the ground. And I guess the other important point to mention in my opening spiel is that they basically want these non-Chinese supply chains. So if China, under a potentially even more aggressive or protectionist government of Xi Jinping, either in 2 years or 5 years or 100 years, assuming he's still around, which he might be then, they can still make cars for people and keep their auto industries going.
Yeah, as you said at the top, one of the things here, as well as these considerable sums, is the way that is really compounding perhaps not the problems for Europe, but the difficulty in maintaining expectations. I think you cite some data showing Europe as a percentage of total worldwide battery production. Those forecasts are really being scaled down, partly because the US is starting to ramp up and looking to keep a lot of that production for the reasons you've just stated, either onshore or close to shore rather than further afield.
Yeah, and I think though that there's so many different data points you can use, and that one you're referring to is basically the whole pie in the last 2 years or 2.5 years. And this is data from Benchmark Intelligence, which kind of leads the way on this stuff. They compared their forecast from 2.5 years ago, January 2020, with their forecast from last month, and overall the pie is bigger in terms of battery manufacturing capacity for the middle of this decade, and the US proportion of that production has gone from, I think, 8 to 12%, and Europe's has come down very slightly. And I think basically what you're going to see over the next few years is China has about 70% of battery production, about 70% of processing, and their share ranges from about 60 to 80% of everything, basically, in the EV game. And basically, the rest of the world is going to be chipping away at that. And it's partly because the Chinese have put so much money into this for so long, and they have so many electric cars already running around, and they might just be funny little runabouts that people have bought rather than, say, a Tesla, but it's still an electric vehicle that might have replaced a car. So yeah, they're far ahead. It's what is interesting to me is that you're still getting companies in the UK and in Europe who are just, they're doing all the right things to form part of this supply chain, but they're still taking such a long time to get it working because it is fairly new technology. And through that pace, you're seeing things like there was a company that is in Finland called Keliber, Keliber, and they were kind of chipping away at various Finnish permits and investments, and actually had the Finnish government on side to build this facility to plug into their local EV production supply chain. And then an American company that doesn't even do electric vehicles just comes along and buys them. And so they now own a chunk of European EV, the European EV supply chain. And it's a sense of kind of the softly approach, both from governments and investors in Europe, has just meant that things are a bit slow, and therefore the share of cars getting sold by European car makers is going to decrease as EV take-up increases because they are just not producing in those numbers.
Slow it may be, but as with any new technology, there is the flip side to watch for if you're an investor, which is that these big promise, big ticket items don't always come to fruition, and sometimes the investor interest can perhaps get ahead of itself. And one example potentially is that of European Lithium, which is perhaps going to list in the US, as you write in the piece, at a pretty hefty valuation compared with its current market cap. It's currently listed in Australia already, I think.
Yeah, and this is a kind of global story that will probably have investors either celebrating or shaking their heads all over the place, because it's an Australian stock exchange listed company that has an asset in Austria it's not massively exciting. It's just like could be a spodumene hard rock mine, and they haven't been getting enough love in Australia. The share price has come down a fair bit. I would argue that they're not unfairly valued, but they want a taste of the New York rush, so they're planning a SPAC listing at the moment. And obviously SPACs have come off the boil and almost discredited as a way to list. We've seen things like Arrival in a similar space just completely drop off since the SPAC listing. Things like that show that the valuation jumped from £70 million on the ASX to almost $1 billion through this secondary listing in the US. Just shows how nuts it's been. But I mean, that's probably the extreme top end of the valuation that some bankers come up with on a half-baked pitch deck. But the fact that someone's even written it down, I think shows that things are rapidly moving on from, for example, the various London companies that have tried to get lithium mines up with fairly low valuations over the past probably 5 years, which in itself has seen probably 2 or 3 very distinct, I guess, boom and bust periods for the battery metals companies. But yeah, I mean, I think the way I end the piece is basically saying there is potential for a European equivalent of the Inflation Reduction Act, and also the fact that maybe institutions like the European Investment Bank, the European Commission, and the European Battery Metals kind of peak body see this and react and throw a few bits of cheese at these companies in the same way that the US has done. And if that's the case, any project that is permitted already on mainland Europe, any midstream processing plants that are even in kind of early development should get a bit of cash as well. I mean, this is all a massive if, but I think it would rapidly change the investment scenario for these kind of projects. And companies like Cornish Lithium, which had delayed an IPO, it would probably change the story a bit. And I've been quite dismissive of that as a company, just because it seems subscale, still in a fairly residential part of the world, and doesn't have any local processing capabilities to send its lithium to. But I mean, a few bill from the EU, even if we obviously remain outside the EU, just to try and start that supply chain a bit better, that would just rapidly change the prospects of that kind of company.
Yeah, perhaps the US activity will be a bit of a indication that they need to get things going, although invariably these things do seem to take time, however much urgency there may be. Well, we'll keep an eye on that as we tend to do. Thank you, Alex. Let's finish today very briefly by touching on a couple of results from this morning. In fact, we're recording on Wednesday, as mentioned. Seem quite contradictory, Julian and Mark, insofar as Google, has had a bit of a warning in terms of the digital ad spend. Figures there were lower than expected, saying, perhaps there's some sign of weakness coming through there. In contrast to the likes of WPP, which has followed almost all its big advertising peers in saying, no, we see no slowdown at all in that spend. Obviously, they're dealing with big issues of their own, such as labor costs and general costs, but they're quite bullish on that spend. And even smaller companies in the UK, S4 Capital, for example, are still, doing pretty well, saying everything's going okay. So it struck me as just quite interesting that discrepancy between, is it between digital ads and old-fashioned advertising? Is it between companies in a certain area and these, conglomerates in a lot of cases who have enough strings to their bow to be able to ride out this area? Is it just something that will come out in the wash?
Oh, I was looking around, casting around to see if I could find some statistical evidence from what happened after the Lehman collapse in 2008, and a couple of years after that. This just refers to the US market, but excuse me, the overall market dropped by about 13%, but it differs quite widely across different mediums. So you had newspaper ad spending that dropped by 27%, radio by 22%, magazines 18%, out of home 11%, television 5%, and online by only 2% as well. And I'm just wondering, because I don't know, I don't think we can necessarily make too many assumptions based on Google's experience there, particularly as YouTube is, it's a more competitive field there because of TikTok as well, no doubt. But I don't know, does this reflect that there's a wider acceptance or appreciation that marketing and advertising spend should be maintained during downturns to, so you hold your market share, and there's a possibility you may be able to gain some as well. But I don't know. We'll have to wait a little while as well, because presumably, we've got a few tough months in front of us.
I also think you tend to find that advertising companies' profitability is sort of lags where the economy is heading. So if there is a secular squeeze on company earnings, then they tend to experience it sort of a year or even 2 years later. I remember that one of the worst years for WPP was around 2010, which is a couple of years after the financial crash itself. So you might be in the post, you just don't know looking precisely from these results. Although I do notice that they were warning a little bit on their margin. They were experiencing some margin pressure, I think, but I mean, not enough to cause anyone any particular alarm. But I mean, I would say that they're more business cycle dependent, which is a much longer cycle than the one we're used to with the market, I think.
There were some positive notes as well this week from, I think it was Nestle said they're going to be increasing their marketing in the second half of this year because supply chain pressures have eased and it's freed up a bit of cash. And obviously companies like Nestle are really, we've spoken about this bit on the podcast before, but they're really under pressure to maintain their brands at a time when people might want to trade down to private label products. So, if you see more consumer health companies, consumer goods companies doing that, that could be some ballast, but I don't think those alone will be enough to bail out the ad agencies if we do go into a proper downturn. We shall see. That brief assessment is all we have time for. We have come to the end of today's show. Thank you to Alex, to Mark, to Julian, and to John. Thank you to you for listening. We'll be back next week, as ever, with another Companies and Market Show.